Hello, good morning. This is Bruce Fleet with Fleet Capital Management. Today is Saturday, July 22nd, 2017, and I thought I would give you an update on some of the systems that the RTA is using, show you some new performance monitoring that I'm going to be bringing online shortly, and answer a couple of client questions that I've received lately. So I hope you find this interesting and worth your time. I'm going to try to keep it to about 30 minutes. One of the questions that I received recently from a client is, how do I make the decisions that I make to buy and sell? What is that process that we go through to get that done? And who supplies those tools? What improvements are coming? Those are just some questions that I received recently. So let me start with, I'm going to switch screens here, and I'm going to move to what's called MarketSmith. MarketSmith is a program that I use throughout the day. It is supplied and created by Investors Business Daily, which I'm sure you're aware of. When I say supplied, the firm subscribes on an annual basis to be able to get this data. None of the systems that we use are given to us. They're not provided to us by anyone. We actually go out and buy them, and then we customize them to work within the RTA system. So let me walk you through that decision-making process. The very first thing that I do, and I'm going to keep this pretty surface level, we won't go into, or other videos have gone into greater detail, but we start with fundamental analysis. The fundamental analysis are things like the earnings of the company, the management, the products, what's their earnings per share growth rate, things like that. That's fundamental to a company. And what I do, and I do this every Saturday, actually I just completed this for this Saturday, is I go through about 300 stocks. The system starts with 8,700 companies and brings it down to about 300 companies, and then I take that 300 companies and bring that down to about 75 companies that I'm going to work with for the week. And what I do, I'll just show you exactly how this works, is MarketSmith takes, like I said, the 8,700 companies that are available, and then it ranks them. It has a composite ranking, an earnings per share ranking, relative strength, and lots of different ranking systems, and it ranks those 250 companies. I go through and look at all of them, and I put a little flag next to the ones that meet my criteria, which are much more stringent than even IBD's criteria. I do that every Saturday. The reason I flag them is the system, I have something called pattern recognition, and you might see like this W, it looks like a W. Well, that's called a double bottom. Here is what's called a cup with a handle. You'll see it in green as the patterns. So what the computer is doing is it's recognizing certain patterns that are pretty standard throughout the marketplace. And I only want to see pattern recognition on companies that I have a flag with. So once these companies are within 5% of what's known as their pivot price, they will populate and show here. And if you can see down here, I've got a number of them flagged, but there are even more that are not flagged. I'm not interested in the companies that are not flagged. So again, I start with fundamental analysis. We've got all these companies, and then I bring that down to about 75 companies, flag them, and I'm looking for pattern recognition. So I use this MarketSmith by IBD tool for fundamental analysis. I also use Zacks Investment Research for fundamental analysis. Now, what Zacks does is Zacks really hones in specifically on earnings. That's kind of their claim to fame. They're looking for companies that have excellent earnings and excellent prospects for future earnings, and what are the analysts saying about the earnings? Have they been revising their earnings estimates upward? So between Zacks and IBD, again, I create this universe of about 75 stocks, and this changes from time to time, but about 75 stocks that I think are showing the absolute best in fundamental analysis. So we've got these companies that I think are the best of the best in America. The numbers change, the companies change every week, but they don't change dramatically. I mean, the best companies are just simply the best companies. And so that's step one, is fundamental analysis, bringing this universe of 8,700 companies first down to 250 companies and then down to about 75 companies. I hope that makes sense. That's the fundamental analysis side. The technical analysis side is used, since I've already honed in on the companies I'm interested in. The technical analysis is used for timing. When should we make a purchase without guessing? But a systematic, proven, repeatable approach that looks at timing or the best time. One of the two I've already briefly mentioned is this pattern recognition that's looking for, again, there are certain repeatable patterns that go on in the stock market year after year, decade after decade. This is one of the tools I use for my technical analysis, looking for pattern recognition, and a breakout would be when it closes above that green dash line. So that's one system. But the system I use primarily is this system. This was something that is a very customizable system. The system comes blank, and then you customize it to the technical indicators you are looking for. So again, and I'm going to be redundant because I know this gets a little wonky, but fundamental analysis first. We've picked our 75 companies that we love on a fundamental basis each week, and then we go into technical analysis to when to buy them. We looked at pattern recognition just a minute. Now we're going to look at this. I created a system which I call 4 crosses. It's an arbitrary name, but it's because I'm using 4 different technical analysis systems. I'm using MACD, which stands for Moving Average Convergence Divergence, and you don't have to remember this. You don't even have to know what they mean. You'll see how I apply them in a minute. I use RSI, which is a relative strength indicator, but I don't use it the way it's classically been used. I've changed the settings on RSI to be a little bit more accurate, I believe. I use something called on-balance volume, which is how I identify if institutions are going in and buying certain securities. That's a tailwind. You know, when institutions are buying, the big institutions, the mutual funds, the state pension plans, when they're buying into a security, that is just throwing fuel on a fire for getting these securities to work well. And then I use something called True Strength Index. So these are my 4 primary pieces of technical analysis, and I'll show you why I called it 4 crosses and how this works. I'm going to pull up Facebook, which everybody knows and loves. Facebook's obviously a great company. Facebook back a year or so ago was this is in 2016 we're looking at now, was trending higher and doing nice, and lots of people wanted to own Facebook. But then, as all stocks do, it fell and it went into a little bit of a downturn. And then it started to come back up. Now, if you see this vertical line that I'm moving, remember that on this particular day, there's nothing to the right of it. It looks more like this, because we're going to go back here just to study, but the future hasn't happened yet. Okay, so the market, the Facebook was climbing back higher, and you're thinking, well, maybe I should buy back into Facebook. It's already done its drop, and it looks like it's time to buy back in. So you buy back in on a strong day. You buy it here, and then whoop, it went right back into another drop. But then turn around and start crawling. This is each of these little candles are called, or one day, and it starts to climb back up higher. Well, I don't want to miss this, so I should go in and buy it, is how most people do analysis, not the way I do it. You'll see my way in a minute. And then you bought it, and it starts to drop again, and you're feeling like such a fool. So the timing of when to get in is a critical thing. Now I'm going to incorporate my technical analysis into this. What would I have done during this time? Well, during that same time, you can see that the TSI, or True Strength Index, was below the 0 line, or the trigger line. You can also see that the on-balance volume was falling. So institutions were actually selling the security. Why would I want to buy against institutions selling? My RSI was below the 60 line, which is my trigger line, so that doesn't look very positive. And my MACD line, this is a more of a bearish cross, was trading down. So I wouldn't have bought Facebook during these times. When would I have bought it? Well, let me put my vertical line right here, okay? And what you can see is the true strength crossed above the 0 line. The on-balance volume is going up very nicely, which is showing me institutional purchases. The RSI crosses what I use as a signal line of 60, and so that's bullish. And we got a bullish cross right here in our MACD, and we went above the line. So that's why I named this 4 crosses. And if I were using this system to buy Facebook, I would have bought right about on that day. And that was a heck of a day to buy. And you know, we've made a fair amount of money a couple of times in Facebook. So again, let me recap. We hone our fundamental analysis down to about 75 companies. We monitor every one of those companies every minute of the day. This system, 4 crosses that I've designed, is watching quite a number of those companies. Not all of them, but quite a number. You can see closely watching over here. And I've also created a scan of the 4 crosses, and let me change that to closely watching and scan. Now the market's closed right now. Here's a couple of stocks that on Friday met the 4 crosses. One of them is a stock we already own called MChip. So let me go over here and let me go down to MChip and show you that. So this, if you see these tiny little bubbles, that was the day I purchased MChip again. I just recently purchased it again. We had made a lot of money. We got sold out of it. We went back in. We went back in because we crossed on the TSI line. I saw on-balance volume going up. The RSI crossed above. Now, Friday was a bad day, so it went back below, but that's okay. And we've got a bullish cross here. So that's why I bought it. If I were to go to, boy, here's a stock that we made a fortune in. Actually, let me just type it into here. AAOI. We just sold that on Thursday, I think. If you see these little bubbles, I bought it because of the 4 crosses. And this stock just rocketed for us. I didn't know that was going to happen, but it met all of my fundamental analysis. It met my technical analysis, and there's some other pieces that it met. So I bought it. It went up 30% or so in about 10 days. You can see this just meteoric rise. I started to get worried about this stock on Thursday because it was way above these moving averages. And stocks just don't generally rise that fast without having a pullback. I also had a stop in place, and we got stopped out of it. And then you can see for the next 2 days, it started to fall. So that was probably a good stop. I want to get back into this company, and I will, but I won't buy it at its high. I want to see it. You can see it got ahead of itself here, and then it came back down. And then it went up, and then it came back and met the line. So that's called reversion to the mean. That's a very normal process that stocks go through. So what I do is I create systems that are embedded in the RTA program or portfolio to give me mathematical signals of when to buy. And that's how we buy stocks. We evaluate, like I said, in a fundamental sense first, because I think that's important. We're looking at the best stocks, the best companies, I should say, out there in America. And then we use technical analysis to figure out buy points. And the technical analysis is either the 4 crosses that I designed, or it is the Market Smith, which was here, which is a pattern recognition. I use those 2 things. I also use volume. If I've got a stock that hits on 4 crosses, but it doesn't have volume, real strong volume, I'll probably wait, because again, volume that's the footprint. That is the footprint of institutions going in to buy. And that just, it gives wind in our sail, and it gives us a little bit more oomph when we're buying stocks. Is this 4 crosses or the pivot point, pattern recognition pivot, foolproof? No, it's not. If it was, it would be very easy, but it's not. But what it does is it increases our odds of success exponentially. And sometimes we have to wait. Like, let's go back to MChip, which I just bought again the other day. I think it may have even been Friday or Thursday. I bought it, and then it went down because Friday was just a down day. That's fine. That does not mean that we made a mistake in our timing. You got to give things time. You got to give them a day or two to get back on their footing. And also the market has to go in an appropriate direction to help show us. So that's the fundamental analysis and the technical analysis. The stop analysis, which I've shown you before, but I'll be more than happy to show again. Let me go to open status. And this, I haven't done this part of my Saturday routine yet. I'm going to do this next when we're finished here. But what happens is every time I put a security in the portfolio, and here are securities that are in the portfolio. For instance, here's Facebook down here. I, as the money manager, own 3,582 shares. You might own 300 shares, but I own them for the portfolio, the RTA portfolio, and I use a trailing stop. Currently, I'm using a 5% trailing stop. What that means is every time, well, let's just say we buy a stock at $100, 5% below that is $95. So that's where our trailing stop would be. If that stock goes down to 95, even the same day we buy it, we're selling it, because that is my maximum allowance of a drawdown on any single security that I'm comfortable with. If that stock goes from $100 to $101, it's then 5% below 101. If it then goes to $102, it's 5% below 102. It always, and this is done second by second as the market is open. But let's say we go to $102, we've got our new trailing stop, and then we go back down to $100. Well, the trailing stop can never go down. It only goes up. So that's, sometimes we get stopped out of securities. And these are, once I put them in, they're very, very automated. I have found through a significant amount of experience that a stop of 3 to 5% is the best way to handle trailing stop management. The market is in a bull market configuration right now. What does that mean? And this is going to relate to our stop management. Here is the NASDAQ, and which is one of the primary indices that we follow. And you can see that this green line is a 9-day moving average. Then I've got a 20-day moving average, then a 50-day moving average, and then a 200-day moving average. That's just an average of prices over those periods of time. When it's aligned like this, the 9 over the 20 over the 50 over the 200, that's a bullish configuration. That is a bull market, period. And in a bull market, I'll use a 5% trailing stop to give the stock a little bit more room to move. If this 9-day average crosses below the 20-day, that just means in the short term, there's some weakness. You can see that it happened back here, and the NASDAQ didn't do anything. Then what I'll do is I'll generally tighten the stops from a 5% trail to a 3% trail, just because I'm seeing or sensing some weakness in the market. When we go back into a full bullish technical configuration, I loosen those back up to a 5% trail, again, because stocks need a chance to breathe. We buy growth stocks primarily, and growth stocks can be volatile. When the market's going up, you'll see that our stocks generally go up more than the market. When the market goes down, unfortunately, but it is true, our stocks will sometimes go down more. So that's why I manage that stop management. So I hope this makes some sense. I'm going to show you a couple of things before we go. Here's the S&P 500. Again, you can see that the 9 is above the 20, above the 50, above the 200. That's a bullish configuration. So we are in a bull market until we're not. Until the technicals tell me that we're not in a bull market. I use the term consolidating market a lot. I put a highlight around this. I was explaining this to someone else. Market was going up nicely, and then it just sort of didn't do anything. It was kind of trading sideways, and then it had a downdraft. and before it started to go back up. This is a consolidating market. A consolidating market is very normal. It's very frustrating. We tend to make no money or lose a little bit of money in a consolidating market, but it's very normal. You also might look at it as the market is catching its breath. And once it's caught its breath, it's ready to run again. Also notice the TSI crosses, the RSI crosses, and we've got a bullish MACD. This would have been a great time to buy back into the market. So we can use this technical analysis both on the market and on individual stocks. But I just want you to know a consolidating market is a sideways. Here, if you notice this is a consolidating market. You see that? That was a market where all of those days, that almost looks like a month, the market really wasn't going anywhere. It was catching its breath. And then it started its upturn again. And then from here to about, until about here, this market was going nowhere. You know, these are the times where it's really, really hard to make money, if not impossible. But you've got to ride through those many times because we're still in a bull market before we go for the uptrend again. So let me go back to the NASDAQ once again. At first glance, this looks like just a rising market. Man, this must have been great. Just every day it's going up. Well, no, it's not. Look at this. That was a pretty powerful downdraft. Then we had an updraft, and then it went back down. Then we went sideways for a couple of weeks before it went down, and then it started up again. So with this said, now we had a really strong up current, but then look at this. It's just going sideways for like 2 months before it runs back up again. So markets don't go up every day. They don't go up every week. Whereas from far away, you might say this is a really beautiful chart. It's just going up, up, and up. But then when you look closer, there are some difficult periods. So I just wanted to bring that up because I do use the term consolidating or sideways market a lot. And I hope this helps to explain. How do we know when we're coming out of a sideways market? Well, partly by instinct and partly by using these technical analysis features that I use, that I've created. So hopefully a quick recap, then I'm going to show you something that's new. 8,700 stocks is where we start. I bring that down every Saturday to about 75 stocks. If there aren't, it can go as low as 50. It can actually go as low as 0, but it usually doesn't. Go as low as 50, maybe go as high as 100, but on average, it's about 75 companies. That's the fundamental work, and then we use technical work to try to time our entries, and we use a combination of technical and stop management to take us out of stocks. Getting in is easier than getting out, but both are critical. So let me show you another piece of technology. This is a company out of San Francisco called Folio. It's not available to the public yet. I am the national primary beta tester for this company. The developer is a guy named Jeff Bowman. Jeff's in San Francisco. He and I found each other on the internet. We became very fast friends. He used to be a hedge fund manager. We both think alike. And he told me that he was developing this, this platform to do performance measurement for portfolios. And he asked me to be the primary beta tester. So we're in beta for about another month and a half. I think we've been 2 weeks. We're going to beta test for 8 weeks before he rolls it out. But what this is, and let me explain some of the things on here. First of all, the market's closed right now, but when it's open, it shows me I created a $1 million portfolio for the RTA. So this is a fictitious portfolio, but every single buy and sell that I do for you, I do in this portfolio. It's automated. So it's a mirror. It's a mirror image. The difference is with a person, with a client, you may take some money out of the RTA. You may put more money back into the RTA. I had one client actually take all of the money out of the RTA for 3 weeks to buy a house. Then they were going to put a mortgage on the house and refund the RTA. Well, that skews performance. That's performance relative just to you. I wanted a way to where I can look at the RTA without having that external noise. So that's what we're creating here. When the day is open, it's showing me the P&L for the day, how much as a percentage we're up, how much as a dollar amount we're up, and it's relating it to the S&P, the NASDAQ, and the Dow. This is pretty fascinating to watch. It's live, second by second. This is where my eyes are a lot of the day. I want to know, how are we doing relative to the other indices? Then it takes this, that's on a daily basis, and it drops it down, and this is the RTA we're looking at here. And what this shows is week to date, this would be for last week now, RTA was up 1.26%. The S&P, which is my primary comparative benchmark, was up 0.56. So you may have remembered in my Friday market close email, I said we lost for the day, we underperformed the market for the day, but we won for the week. This is where I'm getting that from. Our portfolio performance was positive over the S&P for the week. Month to date, and this is a calendar month, so this is July, we're up 4.2%. The S&P is up 2.13. Year to date, the portfolio RTA is up 6.65%, and the S&P is up 11.67. Now, let me make one thing clear. There are no money management fees taken out of this. The trading cost fees, the $6.95, is taken out of this, but the money management fee that FCM charges is not. So this is gross of fees. We're going to try to adjust that and make it net, but we haven't figured out how to do that yet. But in any event, so we're in July, so we charge 1/12 of 1% every month. So you've been charged for, what would that be, 7 months. So if you take 0.7 of 1% and subtract it from this, you would have net of fees. That's how that works. So it's pretty simple. So we're watching on a daily and then long term. We need to put quarter to date in here. We haven't done that yet. Again, we're in beta. We're still fixing this. Down here, this is showing me our exposure to the market. Right this minute, we are 87% exposed to the market, and 13% is in cash. And it also shows me we have 16 securities that we're holding in the RTA. They're all long and none short. Then this shows month by month performance, how we're doing. In January, this is the RTA, this is the S&P. In January, we outperformed the S&P. That's always our goal. February, if you remember, we had we got killed on a couple of bad earnings reports that came in, and the RTA actually lost money when the S&P went up significantly. This was a really bad month. These are the months I get a lot of emails that say, how's your system doing? And I understand that. But then look what happened the following month. We just blew away the S&P. And I think that just shows you the system's working, but no system is 100%. And then in April, we outperformed. In May, we outperformed. In June, we underperformed, just a smidge. But then look at what happened so far in July. We're absolutely killing the S&P. So, month by month, if I tell you that we're in a consolidation period, this was a consolidation period. We didn't lose much. We lost, let's see, 0.2%, 0.2%, not much. The S&P was up 0.6%. So we did underperform, but now we came back and we're knocking it out of the park again. So this is one of the pieces I use. Another piece that's really I love to use is called, not that one, growth of $1,000, growth of $1,000. What we did on this screen is we put $1,000 into the S&P 500, which is the gray line, and $1,000 into the RTA, and we started this January 1st of this year to see how would $1,000 grow, relatively speaking, to the S&P 500. You can see that we're up here. We grew, and this is through Friday, $1,000 to $1,166.48, which is year to date a 16.65% rate of return. And then this is the S&P, which grew to 1,117. And you can see that in March, remember we had a bad month. The green is us, the RTA. We underperformed even on the growth of $1. I would call that pretty significantly, but again, that's going to happen from time to time, and then we just continued on. And what we want to see is, what we don't want to see is really big downdrafts. Yes, this went down a little bit, but then it went back up. I'm trying to prevent any big downdrafts. And I made some changes to the portfolio management here, which hopefully will protect that. You can see small down, small down, small down, not terribly big down. This drifted a little bit, and then we went back up. So there are just lots of ways that I can slice and dice and see our performance. I showed you monthly performance. This is interesting. This is positions. So this is showing, and long. I don't do any shorting, but this, on this day, February 1st, we own 16 positions. Over here on February 8th, we only own 9. So the number of positions that we hold will change based on what I'm seeing in the market. June 9th, the beginning of June, we had a really terrible downdraft in growth, and we went from 15 positions to 5 positions. Now we're back up to 16 positions. I will tell you that a 100% funded portfolio is 18 positions. We'll never have 19 positions. And an empty portfolio is 0 positions. We've done that before. August of 2015 was the last time we were at 0 positions, but that will fluctuate. And then we have our stats page. This is the last piece that I'm going to show you. Hopefully this will populate. I don't know if it'll populate on a Saturday. Let's see if it will. It should. Bear with me one second here. So let's go back over to statistical analysis. There we go. So what this is doing is it's doing, again, since January 1st, which is when I started this, it's saying realized, meaning stocks that we have both bought and sold. They're done. We realize them. We had 73 winners and 70 losers, about 50-50. I'd like it to be better, but right now it's 50-50. But here's the key. Each one of our winners had an average return of 5%. Our losers had an average loss of 2.7. So our winners are beating our losers on almost a 2-to-1 basis. Really good. So even at 50-50, which we saw here, we're winning. We're growing our portfolio. The average holding period of our winners is 20.3 days. The average holding period of our losers is 5.4. We're getting rid of our losers quickly, which is also what we want to see. If we look at unrealized, which is the current RTA portfolio, there are 16 positions. We currently have 13 winners and only 3 losers, which is fantastic. That's what we want to see. Our average return for our winners that are current right now is 3.8%. Our average loss is 1.5. Again, very, very good. And the same thing with holding periods. So this is showing me, this gives me kind of an inside view of how the portfolio as a whole is doing. If you look down here, the portfolio, RTA portfolio, year-to-date is up 16.65%. S&P is up 11.67. I don't care about the NASDAQ. That's not reflective. We are annualizing at 32%, and the S&P is annualizing at 22. Not a really important number, but it's nice to see. Our max drawdown is very low. It's comparable to the S&P 500. Our standard deviation is a little higher, and that's because we trade so much. But we've got a pretty powerful Sharpe ratio, which is a risk-return basis of how we're doing. And we also are outperforming the S&P by 4.98%. You can see that we're adding alpha, and we are uncorrelated to the market. So again, this is something new. I did have a client ask what's new in the portfolio. And I'm going to start showing you this column probably sometime soon. I'll show, and I had a client months ago say, can you show me how the RTA did on a daily basis relative to the S&P? Prior to the development of this system, I couldn't. Now we can. So I'm going to start showing this. But again, we're still fixing things. We need to put quarter to date in here. And so this is a new piece of technology that we're using. Anyway, a lot said, a lot that we've gone over. I hope this has been helpful in answering some questions. Real quick recap, and then we're going to go. 8,700 stocks are available. We pare that down to 250 stocks, and then on Saturdays, I pare that down to 75 stocks that are the companies that I'm most interested in on a fundamental basis. They've got solid earnings, great management, great everything else. Once that work is done, then we go to the technical analysis to help us learn or see when are the most appropriate buy points when we buy securities. So it's either this or pattern recognition. And then we use stop management and technical analysis to create sells. And then I have this new performance monitoring system to create performance. So with that said, I hope this was interesting. I hope it was valuable and worth your time. And if you have any questions about this, always, always, always feel free to shoot me an email or give me a phone call, and we'll go from there. So have a great rest of your weekend, and I will be back with you early Monday morning. Bye-bye.